Good morning, and welcome to the Energy Perspectives Group webinar, hosted by Hemisphere Energy. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Yeah, thank you everybody for attending this Hemisphere. I think this is the third or fourth webinar they've hosted for us, and Don's coming to Houston for a luncheon in late November, so we have that here. But Don Simmons is our speaker today. He's the president and CEO of Hemisphere Energy, which is one of my top picks in our small cap growth portfolio. I think we're up 600 or 700% since we put it into the portfolio. He holds a bachelor's degree of science in geological sciences from Queen's University and is a member of the Association of Professional Engineers and Geoscientists in Alberta. He has extensive experience in petroleum geology and a proven track record of discovering oil and gas in Western Canada and internationally. He became the president and CEO of Hemisphere in February 2008. So like 14 years with the company. Prior to joining Hemisphere, Don was a geologist for Sebring Energy, a private oil and gas company. And then before that, he spent 5 years working for Encana, which is now Ovintiv, which is in our Sweet 16 growth portfolio. And he worked on various projects in Southeastern Alberta and Ecuador. So now I will turn the controls over to Don for an update presentation on Hemisphere, and then I'll come back for the Q&A. Please remember to type your questions into the chat box, and we'll read and discuss them after his presentation.
Well, thanks a lot, Dan, and thanks for everybody for tuning in for an update, and for some people, hopefully the first time you've heard of us. Bit of a different story, and you know, certainly a company that has grown and changed quite a bit over the last few years. That some of Dan's folks have been able to watch us as we've you know, gone from a few thousand, 1,000 barrels a day all the way up to close to 3,000 barrels a day here now. So anyway, I'm going to get into it. We'll go through a little recap and leave lots of time for questions at the end. So our strategy is simple. You know, we like to keep it, you know, fairly straightforward. You know, keep it simple, keep it clean, be profitable, and have something that makes us a bit unique. So what do we mean by that? Simple. We're a bit old school. We're conventional oil, large oil in place, low recovery factor. That's the prize. By clean, you know, clean balance sheet. Great shape. We have very low wellbore and facility liabilities. We're profitable. I mean, on a net back basis, we have high free cash flow, and we have a top tier oil resource. What makes us unique? I mean, we're becoming less unique as more and more companies pay down their debt or pay off their debt. So we're very low debt, heading towards, and you know, at this point, basically no debt, and we have a fairly you know, important return to shareholder strategy. We've started dividends here in 2022, and for the last few years, we've had a share buyback or an NCIB ongoing. Some of the key things to know, some of the key numbers, and if you look at the map where we're located, so we are down in Southeast Alberta. It's an area called Atlee Buffalo. It's about 2.5 hours east of Calgary, and about an hour north of the Trans-Canada Highway that goes through Medicine Hat. So easy place to access, good farmland, great place to do business. We do trade on the Toronto Stock Exchange and the Venture Exchange under the symbol HME. And for the last couple of years, we've been trading in the US on the QX listing, HMENF. Share price, when we did the presentation, I think we're bouncing around with oil here right now. We're around $1.50. Insider zone, 14-15%. Shares outstanding about 103 million, and fully diluted 105 million. So that gives us a market cap of around 150 million. And at the end of Q2, the last numbers out in the market, we were just under 4 million in debt. So about 157, $156 million enterprise value. Corporate production for Q3, we've put out an estimate somewhere between 2,800 and 2,900 BOEs a day. And again, we're 99% heavy oil, so very small amount of associated gas. Another thing we like to highlight is that reclamation and abandonment liability out in the future, very low. So undiscounted 8 million, and discounted out into the future under 2 million. Again, it just kind of reflects the growth that we've had in our production and our reserves has really been through the drill bit, not acquiring old assets with that come with a lot of wellbore and facility liabilities. So Q2 is the last numbers out in the market. Kind of feels like a long time ago. We will have our Q3 numbers, I believe, the morning before market of November 17th. And then I'm actually coming down to Houston and Dallas and Atlanta for presentations later in November. I think it's the week of the 28th. So I'll be able to give an update on Q3. But Q2, we were just under 2,900 BOEs a day. Great quarter. I mean, obviously for everybody in the business, it was probably the best quarter from a price point that we've seen in a long time. So we had over 30 million of revenue, 116, almost $117 per barrel. Net back out in the field, almost 19 million dollars Canadian, $71 a barrel. So cash flow or adjusted funds flow, 14 million or $53 a barrel. We spent in the quarter on drilling and facilities just under $6 million, and we exited the quarter with the lowest debt we've had in a long time, 3.7 million. So how does that stack us up? You can see there's a couple of charts there. We take a lot of the other oil-weighted public companies and their Q2 results, compare us to there. We're right in the thick of things with our cash flow per barrel, and you can see we're one of the companies with the best metrics on the net debt to cash flow. So again, we're getting towards the end of the year here in Q4, but what were our goals? What was our guidance for the year? I think we updated this guidance in June, given the price of the oil at the time and where we were. So we're looking to average about 3,000 BOEs a day, exit around 3,300. We're looking for cash flow or adjusted funds flow for the year, around $50 million or about 50 cents a share. CapEx for the year is around 16 million. So that leaves us free cash flow or free funds flow somewhere in that 30 to 35 million dollars for the year. If we look back, what have we done as a company? We've been fairly continuously growing through the drill bit, these assets that we've had. We haven't made any acquisitions for quite a while now. We've been focused on developing the pools and the oil pools that we had. First was drilling the pools up, then it was implementing a water flood, and then over the last year now, we've implemented both of our main pools anyway, polymer floods to capture more of that oil in place. You can see that growth through the production over the last few years. You can see the growth on the next graph to the top right on our reserves continually growing year after year with that development. And then, one of the most important slides is how's that cash flow growing? So you can see we're a company that, we were small, we didn't have, and prices were challenged, volatile. We were spending a lot more than we were making in order to grow and develop our assets. You can see that changed back in sort of 2019, 2020. 2021 was a year where we actually made more than we spent, and then this year you can see that big jump. And obviously, some of that is a big part of its production growth, but then again, a great help and a boost with oil prices this year as well. And again, the last slide just really shows you as a company how we've moved from developing our asset, borrowing money, going into debt through 2017, 2018. and then continually are developing, but also paying down our debt over the last few years. And as we look at 2022, moving into a cash position. And again, that highlights the cash before our dividend payments, before our NCIB. But you can see we've become a company that can actually now focus on returning more to shareholders, which leads to this slide. So we did, we've been active on a share buyback for a number of years. And I would call it, it's not a systematic, buyback. It's more of a strategic and opportunistic. So we look at the market, we look where we're at, we look at our peers, and, we tend to implement our buyback that way. In summary, we've bought over 5.2 million shares and spent about $3 million since September 2019. And this year, as our debt got closer to zero, we implemented a quarterly variable dividend, and it's based on paying out approximately 30% of our annual free funds flow, and that annual free cash flow. So right now, the implied annual yield is over 6% at a market cap of around 150 million. Paid our first dividend in June, 2.5 cents. Paid our second one in September, 2.5 cents. So far, we've distributed over $5 million over the last 4 or 5 months here. What do we do with the other 70%? So with that other cash flow, free cash flow, we are looking for strategic acquisition, something that we can bring our experience to. We're good at analyzing 3D, horizontal drilling, water floods, polymer floods. We're not against fracking. If we find an acquisition where horizontal wells and multi-stage fracking and the economics are there, we certainly, we're looking for things that we can really bring our drilling experience to. The other thing is accelerate some of our internal projects. There's many things that we've worked on over the last number of years and ideas that we have on things. We've been cautious in this environment not to go out and do too much in the way of more sort of exploratory type things. But certainly through 2022, we've tried a few things. There's other ideas and other projects and other lands that we could put some capital towards. And then again, if we don't come up in the short term with an acquisition, and another thing we can look at is special dividends as we go. So where's the foundation of the value of the company come? And really, you can look at our reserves, you look at these pools that we have and the underlying value. So remembering a reserve report is it's a third-party audit of the future cash flow of our company based at a specific price of oil and gas. So for us, end of last year, our proved developed producing reserves was almost $200 million Canadian, just over 7 million barrels. Our proved reserves, $275 million, 12 million barrels, and our 2P reserves, 350 million and just under 16 million barrels. Again, it's a great way to compare one company to another company. Every company has different types of assets, different mixtures of commodities, different operating costs, different royalty structures. So, the nice thing with reserves, it includes all that, all your future development capital, your costs, your royalties, your decommissioning liabilities. So really does give you a good picture of the underlying value of a particular company and what kind of reserve life they have. One thing to note, last year's reserve report in Canada, you'll see this from most Canadian companies. They have a formula for how they set their price deck. And from last year, because of where the price was at the end of the year, the average WTI price from 2022 to 2026, so over the next sort of 4 years moving forward, they're using under $70 a barrel. So I think it's fairly conservative, at least for where we sit today. Some of our great metrics, a 2-year average F&D costs of under $7 a barrel and a proved reserve life index of 18 years. What does that mean from a net asset value or share price? If you're looking at that, I'm not going to go through all the graphs. I'll focus just on the two in the middle. At the $70 WTI third party price forecast, that would equate to $2.45 a share. If you ran it back when we did this, big update on this presentation for our guidance at $100 WTI in Q2, it's $3.80 a share. So significant upside. Again, most companies right now, at least in Canada, they're not really trading on reserve value or the future value or the type of asset. It really, shareholders are focused on a cash flow multiple, and basically anywhere in a 2.5 to maybe 3.5 times cash flow as they look at 2023. So a little bit more about the pools. We've looked at the reserves. What about the underlying actual rock? These are two conventional oil pools in Atlee Buffalo. High amount of oil in place and a low amount of that oil taken out. So low recovery factors at this point in time. Exceptionally good quality porosity of these pools. We own it 100%. We operate it 100%. These pools were delineated and discovered back in the late 70s and 80s with vertical wells. We've shot 3D seismic over these pools, so we have a great understanding and picture of how big these pools are. And with both our pools now, we've moved from primary to secondary and even tertiary recover with our polymer and our surfactant flood. And again, kind of low risk drilling, low cost. Wells are about $1 million, low decline development. In fact, we have parts of the pool where we're implementing the polymer flood now, and we're actually still seeing incline in those areas. So it's a great asset to have as the base and the foundation of a growing company. So here's what we've done over the last couple of years. 2021, we drilled 7 wells. We implemented the polymer flood in our bigger pool, the G pool, which is on the map, the one in the top right. And in order to handle the additional oil production that we've gotten from that polymer flood, we expanded our G pool facilities. In 2022, we ramped up again. We brought 4 wells online in our F pool that we drilled late in 2021. We brought those on early Q1. We drilled 3 G pool wells and a couple F pool wells in Q2, Q3. We've converted one of our G pool wells to injection. We have just received approval for a second one, which we'll be doing here, I think, later in the month of October. And another key event that we've done so far this year is we started up our polymer flood in the F pool. And we started that in August. So one thing we're working on here still as we're in Q4, we're going to be expanding our facilities at the F pool. We've got to add in a treater to handle more of our anticipated oil production growth there. And we're finishing up a 4-well program here in the fall. We should be finished in the next week or so. Things that we kind of ongoing, we're always looking to optimize our polymer flood and our injection, both at the G pool and the F pool. And something new this year, we did actually allocate some of our CapEx towards what I guess we'd call a little bit more exploration. So we've tried some higher risk, higher reward, but low cost ideas. We've tried some step outs here now on some lookalikes to our Atlee pools. We've tried some new zones and some new technology to see if we can get to better wells and better reserves and better economics. So why polymer? Now that we've put both of our pools onto a polymer flood, a lot of people, not aware of polymer or maybe haven't heard of it. But I will tell you, it is not something new. I mean, it has been successfully used by many, many companies around the world on hundreds of oil pools. It is a proven method of EOR, or getting more of that oil out of the ground. All we're doing really is adding a powdered polymer into our injection water, which comes from the zone, to increase its viscosity. So you can think of it as it almost ends up something like an olive oil. And the idea is if you look at the diagram, the block diagram, you can see 3 horizontal wells drilled into the sand, 2 producers on either side, and the polymer injector in the middle. And the idea is that as you inject that, you build up this polymer wall over the course of a number of months and years, and you really push more of that oil more effectively, more efficiently through the rock to the wells. And you also limit your streaking of water from your injection to your producers. So what do we look for? We look for an increase in our oil production at our offsetting injectors. We look for a decrease in our water production because you're not moving the fluid through the rock as quickly. And overall, why are we doing this? We're doing this to get more oil out of a known resource. So we're using existing technology, existing infrastructure in order to maximize the recovery of the oil that we know is in the ground, for an added cost of the polymer and the associated equipment with it. When it comes to ESG, I can tell you, like every other Canadian CEO and company, we are committed to the highest and beyond our regulatory regime here in Canada. What do we focus on at Hemisphere? Certainly utilizing the EOR in order to maximize and reduce our footprint for our production. We reuse and recycle not only our own equipment, but equipment that we buy. We very rarely buy anything new. A lot of times we reuse equipment that's not being used in other places. We use multi-well pads. Again, farmers love it. It makes more sense from an economic standpoint. Everything in our fields are pipelined to a central facility. So we limit field venting and flaring. We also reduce any trucking emissions. And then one thing I like to point out, we don't use any surface or fresh water in our EOR operations. It's all from brine water, either from our aquifer or from our zone, and the water from that zone, or from another salty or saline brine and zone. When we look at the social side, we hire local companies, we support the people and businesses in our communities. We believe in building a very positive and constructive relationship with everyone involved, whether they're people and partners we work with, other companies, whether it's the landowners, and whether it's just the people that in the communities that we work. On the governance standpoint, really, I mean, safety of our employees and anyone involved is number one. And we believe, I mean, certainly I do, fostering a culture of integrity, honesty, accountability is key to running and having a good company. There's the management team. We've been together for quite a number of years here through the ups and downs. We had a lot of the team has been together since I'd say 2013, 2014. We were had a little quicker plan involved, but oil prices had a lot to say of that. We had to go a little slower and live within our means longer than we had anticipated, but we're starting to reap those rewards now. And really, I mean, that is the Hemisphere story. It's pretty simple. I think we're somewhat unique, but we provide an opportunity for some pretty big value. Thank you very much.
Good job, Don. Remind everybody on the call, if you have any questions, please type them into the chat room and I'll read them. I've just posted some here that were sent to me or that I just came up with for Don. Don, would you please go through how Canadian companies report their royalties in the U.S.? U.S. companies just report their production net after royalties. It doesn't even show up on the income statement anywhere. And then how that's calculated, because I know your percentage has been changing.
Oh yeah, it's very, very different in from Canada to the US. So so yes, the reporting is different. That's quite simple. We just, we report before royalties, whereas you guys report afterwards. So you'll see it in our line items on our when you look at our news releases, we break it all down to what our royalty payments were, and I think we usually do it on a per barrel basis as well. Why? What else? Other things are different from our royalties. Well, in Canada, on what we call crown land. So it's called crown, but the royalty actually goes to the provinces. And it's deemed provincial land or government land. There's a royalty structure that's sliding scale. And so what that means, when the price is high, it scales up to a maximum. I believe the maximum in Canada is probably around 40%. So that means you got to have an extremely good well, production wise, and a very high price. On the flip side, it scales down to a base, I believe, probably close to 2%, where, as the price comes down, like we've saw through 15, 16, 2017, 2018, 2020, you see a lower royalty. And again, it's helpful in Canada. I'm sure, like other parts of the world, we do have a lot of operations around the provinces here where, you might have 1,000 wells all producing, 5 to 10 barrels a day. And it's a mechanism that those barrels really don't get taken off the market. They get helped by that lower royalty as the price comes down. So that's one way. We also have another reason why you'll see some fluctuation, even if the price stayed the same, is we do have royalty holidays on new wells. So a new well, depending on how deep it is and depending how long the horizontal may be, gets a flat 5% royalty until you get your CapEx back. And there's a bit of, it's not exact CapEx. They do a kind of a rough formula for your depth and your length of horizontal. They apply what we call a C-star, which is a value to that. Once you've got that back in return from production, then you go on to the sliding scale. So you'll see, new wells. If you drilled a whole bunch of new wells, you might see your royalty rate go down until you got that money back, and then it'll creep back up again.
Yeah, it's actually a pretty good system. I mean, it's kind of like a hedge on the downside, right?
It is a hedge.
It's great.
100% is a hedge. It's a great way to look at it. And
I mean,
that's why Canadian companies probably in general don't hedge the same way that US companies are, like similar companies in the US would do. That's a very good point.
Yeah. Well, I noticed the royalty rate in Q2 was like 29%. And I'm using 28% in the second half because you are bringing on several new wells. So is that reasonable to expect a little decline on the?
Well, yeah, we're going to see a decline for a few different reasons.
And because of price.
Exactly. So the price is lower than Q2. We drilled some new wells, so they're going to have a lower royalty rate. And then one other reason is, so doing some of the polymer floods, based on economics, sometimes you get a royalty holiday for implementing secondary and tertiary projects. So for the F pool, for a period of time, we do anticipate getting a royalty holiday applied there.
Okay,
so we should get a bit of a break there too. Yeah.
Yeah. One thing I'm always asked all the time, when the oil price goes down a little, well, how low can the oil price go? And these companies are still cash flow positive. I always remind them that, we did survive 2020 when oil was down below 40 for quite a while. So, the thing, and I'm just looking at my model right now, you're all in cash costs, operating expenses, transportation, even if I throw in G&A, you're only at about under $20 cash
Yeah.
cost, not even that, probably
Correct.
25 or something.
Correct.
So-
And that's because if you look back to those actual quarters, and I can't remember the exact number of oil price, but you're right. I mean, OpEx and transportation, let's just, call it, even if it's 12 or 13 bucks, G&A and interest right now, well, interest is minimal. So, $3. And then the royalty, I mean, yeah, it was, high in Q2, but if you go down to a $20 or $30 WTI or a $40, your royalties now $2 or $3, right? So you're right. You're well below, a pretty low oil price. And the other benefit we have that people don't really take into consideration is the Canadian dollar. So we get US price, but then we convert it to Canadian dollars. It's a 1.37, so a 37% increase on our price because of how weak the Canadian dollar is to the American dollar right now.
So right now that's helping you, right?
Oh, it's helping us huge. And
See, that's something I probably need to correct in my model for sure.
wow. And and your guess is as good as mine. We did our guidance on a $1.25 exchange, and that seemed, geez, is that going to be okay? And then the flip side, so that's on the positive side. On the negative side, though, right now the differentials have widened because of the refineries that are down on the Gulf Coast. So
Right.
for our heavies, we got they widened out a bit more than average at first here in Q3 because of the SPR release. There was a release, as you all know, of the SPR, and a lot of that initially was heavies. So they, in some ways, kind of flooded the heavy market down on the Gulf. So that backs all the way back up to Canada and our heavies. And then, over the last number, I'd say month, they've switched from releasing heavies more to lighter oil. However, then we've now started to have some unplanned refinery downtime. And again, it happens every now and then. It always seems to be Q4 for whatever reason.
Mm-hmm.
So you'll see, like, we even earlier in the year locked in some differentials for hedging, I think 400 barrels or 500 barrels a day at around $20. So and today it's currently, 27. I think it's looking to average for, so that's quite wide, right? So that's one of the negatives, but the Canadian dollar certainly is offsetting that, with how weak it is to the Canadian dollar or the US dollar. Yep.
Well, do you have, like, how much interest-bearing debt do you have? You're not going to have much in the fourth quarter, are you?
Unless I make a big acquisition here.
Yeah. Well,
you're right. I mean, we're only 3.5 million or something at the end of Q2. So, I'm pretty darn sure we didn't spend more than we made.
Not according to my model. You should have a lot of course you do spend more in with those 4 wells being drilled. That's for sure.
That's right.
Yeah.
And, and a bit of facility work. We started up the Polymer, we implemented that. So yeah, there was definitely CapEx in Q3, and we paid one dividend or two. I guess we paid one dividend in Q3 as well.
Yeah. I do want to mention to people, and you can talk about this too, there is seasonality to the oil and gas operations up in Canada, obviously because of the weather. But you can talk about it. It's actually not difficult in the winter because the ground is so hard from the freezing. The downtime is usually in the spring when the ground starts thawing. How much of that impacts where you are at Atlee Buffalo?
So it doesn't impact production at all. It really just influences when we're active drilling. And so, most years will be mostly active through the summer and the fall because the weather's great, it's dry, you don't have any issues moving equipment around, and the days are long. So you get, it's not that they work 24 hours a day regardless, but just from, if you have your choice, having 12 or 15 hours or more a daylight is always better than 8 or 9.
Be dark all the time.
Yeah, exactly. Right. So, and it's always easier to do work at 20 or 30 degrees Celsius than it is at -20 or
Yeah.
30 or 35 degrees Celsius.
Yeah,
Now,
especially when you're handling fluids sometimes.
yeah, exactly. So it doesn't mean we don't drill. We've drilled in the winter before. I don't know whether we'll, we've got budgeting season here kicking off next week. So we'll start to look at those plans for 2023. But yeah, I think the biggest impact is Q2, usually April, May, sometimes a bit of June. And really what it is they put road bans on. They don't want you wrecking all the roads when things are soft. You'll just wreck all the pavement by moving around the drill rig. So they just don't let you do it. And then some of it's just respect for farmers. Like if the farmer comes in and says, hey, I just don't want you, rutting up and ruining my stuff right now, we just don't work with, most of these people we've worked with for years. So, have a great relationship with it. And if that means putting off drilling a well for a couple months to keep that relationship strong, then we will.
Yeah. Well, when I was at Hess, we had big operations in North Dakota, which actually, believe it or not, for your listeners, the North Dakota weather is actually worse. And they really would shut down a lot of stuff in the second quarter, April, May, June, and then we, start up, but then drill into the winter a lot of times because it didn't hurt it. It kind of leads into my question: how much more running room's a big deal, for our members. The strong balance sheet's a big plus for this company. Lack of interest expense and the debt risk is a big plus. Running room is also one of the factors that I look at on valuing a company. So can you talk about the running room? How many more well locations do you have at Atlee, Buffalo? And kind of what's the upside? Let's say that both the polymer floods work. Where do you think, according to your engineering guesses or whatever type curve, what do you think? Where could production be in a couple of years if both the polymer floods work?
Okay. So this is something that comes up all the time, and obviously we talk about it all the time too, because we are not the type of company or the type of asset where we have townships and hundreds of sections of land and hundreds of drilling locations, nor do we have declines that are 50, 60, 70% in the first year of our wells. So it's a little bit different mindset when we look at our asset or what we currently have. So yes, there still is some running room. I mean, Atlee probably has, I don't know, 15, 20 more drilling locations. Depends on some of the success of this latest program. Maybe that adds some more here in Atlee. Maybe it adds some more in our Jenner assets as well. So we've got drilling for the next number of years, based on the fact that we typically drill 7, 8 wells a year. But the most important thing to understand from these Atlee assets and the polymer floods that are in them now is that we're not as interested as running up production to the peak that we can get it to and then declining. I would much rather see us run up production to a number that we've got facilities built for, that we can then hold it at that production for 5 or 6 years before we start to see the decline. It's not, that way it saves us over capitalizing on facilities. So, what do I mean by this? So instead of running up, drilling all those wells really quickly and getting production to, 5,000 barrels a day out of Atlee, why not get it closer, maybe, systematically and build infrastructure for maybe closer to 4,000-ish barrels a day and hold it there for a longer period of time. So that's, and our modeling shows we should be able to, if we can hold production in Atlee out of those two pools with a polymer flood and some infill and some optimizing for 4, 5, 6 years, I mean, that's huge. We're trading at less than 3 times cash flow today. So if I can have a product that, and cash flow guidance that I can see fairly flat from your base assets, from your foundation for the next number, 5, 6 years, that's a pretty good situation to be in. Now, that being said, we're the same as everybody else. I'd love to have 200, 300, 400, 1,000 drilling locations teed up, for the future as well. And we continue to look at other opportunities. We don't want to take on too crazy a liabilities to do a deal. And we're looking for assets that we can really, like I said earlier, bring our expertise, to really add value. So, with our balance sheet today, we're in a much better position to be able to act on some of the opportunities that come along than we were even a year ago, year and a half ago.
Yeah, well, I'm looking at my forecast, and if the oil price stays at $100 Canadian and not the $100 US, but if your realized oil price stays level off at $100 Canadian, you should be generating easily like 60 to 70 million Canadian in operating cash flow. And then wasn't your CapEx budget was only 16 million this year, right?
Well, that's right. And you bring up an important part. Our that's another key part of these assets. So you've got this flat-ish, or we're still going to grow from where we are today, but a fairly flat production profile for a number of years with very minimal maintenance CapEx required to keep it there, right? So you're right. If you're making 50, 60 million of cash flow a year, but you only need 10 to 15 million of that to hold it there, or to grow it and then hold it there, I mean, that leaves a massive amount of free cash flow for other things, whether that's, drilling some other plays that we have, making acquisitions. Absolutely. It's a great position to be in.
Yeah. And can you go back to the slide where you show, what your net asset value is per share? A couple things I want to make sure.
Reserves,
okay. Yeah. First of all, people need to understand that's Canadian dollars, right?
Yeah.
Okay. That's Canadian dollars. And that's based on last year's proved reserves, third-party consultants' use of the price. And like you said, they were using like $69 Canadian per barrel oil price for that. So just the fact that they're going to use a much higher oil price, Hemisphere's net asset value, because since they don't have much debt now, net asset value is the present value. Is it discounted at 10%?
Correct.
Yeah, yep. It's a PV10 value of future cash flow less debt divided by the number of shares. Now, also impacting this is the number of shares. Tell us about your stock repurchase plan.
Yeah, so we've been active on it. I think we just announced a release yesterday. I think we bought back almost 600,000 shares just in the month of September. When we saw pressure, we saw oil price drop from, whatever it was, 100 or high 90s down into 78, 79. And we took the opportunity to be more active on the NCIB. That's kind of what I mean by, opportunistic and strategic. We don't have a systematic, like, hey, every day buy, 50,000 shares out of the market. We like to be a little more strategic on that. And that's right. And we can slowly but surely eliminate more and more shares at the same time giving shareholders a dividend. And it's, at today's price, I don't know what we're trading at right now, but it's almost 7% yield. Annual yield. So it's
well, and the thing, and I always say that if you're an upstream oil and gas company and you're a going concern, so you're just not depleting out your assets, you should be trading for at least the P1 net asset value? Because
So-
that's kind of an assumption you're just going to deplete out what you already have and not drill any more wells.
Exactly. Well, it's even worse than that, Dan. We're trading below our PDP value, our blow down. If
Just
I
PDP.
if I stopped coming to work every day and hung out at home instead of getting up at 5 and coming in the office, then we should be worth even more a share. But that's the market today, though, and that's the opportunity for investors today. If you believe in oil, if you believe in markets, the market and the generalist has been very reluctant to come back in, and how can you blame them, right? Like,
Right.
we were just at $130 oil 5 months ago, and here we are, back at 80, and we all look at it and say that we know how tight the supply demand picture is. We haven't even talked about that, but you have in a lot of your notes and your weekly updates. We can see where this is headed in the oil market in 2023 and beyond. But, then you've got the tug of war of, recession happening, and all my other stocks are down, and I need cash, and my mortgage rates are higher. I'm going to sell everything, or I'm going to sell,
Right.
and in Canada, I mean, I talked to lots of even oil investors, guys that, in some cases you kind of thought they'd know a bit more or think a bit more, but they don't. It's totally a cash flow multiple today. And it'll be like, oh my God, Hemisphere has just traded to 3.2 cash flow times cash flow. I'm going to sell them, and I'm going to buy this other company that's trading at 2.7 times cash flow.
Right? I know. And then not even consider the debt or anything. Yeah, I've never seen companies of this quality trading for such low multiples of operating cash flow. And it makes me wonder why more companies aren't being, buying out to go private, or else somebody, buying up a bunch of these little companies and putting them together. We are seeing some of that. We're seeing some mergers of equals and everything. And the other thing we're seeing down here is companies, this is like Earthstone and who else, Silverbow the other day announced an acquisition. They're buying out private companies.
Yep.
And a lot of these private companies were built with drilling programs where investors put in, whatever, $100 million, and they drilled all these wells. Well, those companies, based on drilling programs, they can't keep going back to those investors and say, hey, we got a bunch more drilling locations, so send us another 100 million and we'll develop that. They can't keep tapping that well, because those type of investors want to put in money up front, and then they want, dividends coming back to them. So they don't really grow. So the only way they can realize their value is they sell out to a public company or whatever. Then that money goes back to those and then they can go back to those investors and say, hey, we're going to start a new drilling program. Come and give me more money for the next drilling program. And that's how that works. So are you seeing that? Are there quality deals for sale up there?
Well, because of the extended downturn, I mean, a lot of companies have either been bought up already, or they've gone bankrupt. Like, they really just didn't make it, and assets are, maybe they made their way back to a company through receivership. But we'll always continue to see some deals and some M&A, like companies like Hemisphere, and smaller and a little bigger. I mean, there used to be 70 companies publicly traded like this. If you go back,
consider juniors,
years.
Canadian juniors. Yeah.
Now there's, I don't know, 5 of us. So there's not as many out there to consolidate. We do have a number of privates. A lot have been consolidated already, and I think you'll see some more. There's a lot of private equity's been very cautious to come back in after being bitten so bad over the last 7-8 years. That they're sitting on some really good assets. They don't love the multiples they're getting offered, but they're willing to take it, and sometimes they're not willing to take it. We know that there's deals that haven't gone through because the buyer and seller just can't come to terms on the right price. And it goes back.
One way to solve that problem, though, is you give them some cash and shares.
Yeah.
Because then they're participating in the upside of your shares.
Correct.
So if their argument during negotiation, well, this stuff's worth a lot more than that. Well, then they should be willing to take your shares because it should help you. And that's what Earthstone's done. They've done like 4 or 5 deals where they give half cash and half stock. So
And that,
anyway,
and then, and I think that that works in cases where, it's a strong management team and people believe,
Right.
you can rally around it. Some people are cautious and would be like, well, hey, do I trust all my money and shares in this new company with those guys and their assets versus what we're doing? I mean, you kind of see a bit of everything, but we will continue to see up here, just like you're seeing,
Yeah.
consolidation. And it does, when the price of oil whips around as much as it has here over the last few months, it is sort of sometimes hard to nail down some prices.
Right. You don't ever consider doing something in the US, do you?
It would be pretty tough. I mean, the way I look at it is there's a lot of smart guys down there. And if I'm getting offered something,
I don't know about that.
well,
The ones that are around. Yeah.
If it's making its way up to Canada and it's making its way to
Right,
my desk,
true.
I feel like it's probably gone through a lot of
that's
a lot of eyes. So and in that, in general, goes for kind of anywhere international outside of our. I feel like we've got a very good understanding of Alberta, Saskatchewan. We should use that to our advantage to pick up our next asset.
Yeah. Hey, let me get to a couple of these questions before we run out of time, about 10 more minutes here. When will we know that the polymer flood is working in the F pool? And really looking at the G pool also, what are the things that tell you that it's actually working in the G pool?
So the G pool, which we put on, it's been on for more than a year now. It went on, I think, in August 2021. So it goes back to, I don't know if everybody can see that polymer slide, but increase in oil production, decrease in water production. The overall oil recovery, that's over the next couple of decades. But the increase in oil production before we put that on. Now we have drilled, we've got to remember, we're still developing the pool and expanding the flood as we go. So it's not a direct line, but our production in the G pool has gone from, 1,200 barrels a day before the polymer to, I think it's like 2,300 barrels a day today. And so a big chunk of that is the polymer flood. So we know we've got an increase in oil production. So the other part of that is, have we seen our oil cut increase, our water cut decrease? And you're not going to see that data, but yes, we have. We have seen that, as we're mixing that in, the water, because it now has the polymer and it's more viscous, just doesn't travel through the rock as quickly. So therefore, intuitively, you should get less water back with your oil production, and we are.
And you're just re-injecting all that's coming out in the water. It just gets re-injected, right?
100% goes into our facilities.
Yeah. The
oil gets taken off. It has to be 0.4% or less than 0.4% water. It gets trucked. I don't know. I was out there last week. We had 3 trucks lined up. So they're coming in all day. Take that oil to sales. The water goes through it gets separated out. It goes now through our polymer skid, which is where the polymer gets added to it to get that viscosity back up to the numbers we want. And then it goes through our pipelines back out to our injectors. And it just, and eventually, you do start to have some polymer in that water. And the hope is that it keeps the water a little bit viscous. So then you have to add less polymer.
Right. Yeah. That was my question too. Is there a point in time where you'll quit adding polymer? You just keep recycling the water at some point.
You'll never quit adding polymer I would say over the next, I think we're in our modeling, we look at sort of 5 to 7 year time frame where you use polymer. And then then you basically chase, it's like, a beer and a whiskey or whatever, you chase the flood with water again afterwards. So you actually flush it all through again. Then the F pool was the other question. So we just started the F pool. Our modeling shows, because the pressures are higher already in that pool, it's a bit of a smaller pool and it's a little bit more heterogeneous, that we don't anticipate seeing increases in production for, I think it's close to a year. Like it's 9 months to 12 months before we really start to see the production increases there. And we don't anticipate seeing the same response in production increases in the F pool as we do in the G pool. And part of that reason is because the G pool, the pressures were so much lower. We're flushing more oil, but we're also at the same time increasing the pressure in the reservoir to help the energy in the reservoir move it. So it's kind of a double whammy in G. We don't get as big of a whammy in the F pool, but we will, and we'll also get, it's really getting more of that ultimate reserves out of that pool. But in a year from now, we should be able to, hopefully when I'm giving this presentation, I can say, hey, we've got a bit of, we've started to see some of the oil production increase and also a bit of the water production decrease in the F pool.
Yeah. And what I like about it, and for our listeners, a company like this is they can be real flexible on their capital program. They don't have to keep drilling wells to hold production flat. The polymer flood is increasing production on its own, so you don't have to keep drilling more and more wells all the time. And so let's say that you do have something happen, the oil price drops back to 50 or whatever, they can live within that cash flow easily and still consider going. And these are long-term projects. This is not like, these big horizontal wells they drill, they come on, they're producing 2,500 barrels and they pay out incredibly fast. They're still great and they go on, but their decline curve is so much that for the companies to keep the production flat, they have to have a continuous 3, 4, 5 drilling rig program going constantly. They just have to keep drilling to do that, which is one reason why, in the US, I think, EIA and all these people, they thought that US production would bounce back very quickly. I talked about this in my last podcast, and it hasn't. And the reason why is, more and more of our production is coming from high decline rate horizontal wells. So it's going to be harder and harder to we're not going to have the same rate of production growth that we had in the early days of the shale revolution or whatever you want to call it. It's just the math doesn't work. What else? I was going to go to Scott's got some comments here. I guess I'll just read through them. Yep. There's really no much change in your production and growth plans. Pretty steady. It's pretty easy to model. We got, steady 200 or 300 barrel a day production growth quarter over quarter. Debt expense near zero. Some growth in CapEx budget that is priority in order of allocating free cash flow between asset acquisitions, buybacks, and dividends. And what's the environment like for acquisition? We already talked about that. If you don't do an acquisition, okay, so if you don't do an acquisition and the board has said you're returning 30% of this to the shareholder, so you mentioned a special dividend. So there could be a special dividend after year end if you don't come up with some kind of acquisition.
Well, at some point, yeah. I mean, the plan isn't to sit on, tens of millions of dollars, waiting and I would love to find things like Atlee where, you invest $1 and we make it worth $2 or $3.
Right.
I mean, and if I can't, then as a shareholder, give the money back to me and I'll find another place where I can get that return on that investment. That's typically that's how we look at it. That's how I look at it. Hey, we want to have the flexibility and the ability to strike on a great opportunity that comes, but we also know that shareholders value having that, if we're not doing something with it, put it back in my bank account.
Yeah. And it's always a possibility somebody could walk in with an offer you can't refuse for the whole.
Oh, hey, what I say is everything's for sale. for the right price.
Yeah,
right?
and in Canada, you still have a lot of those dividend paying companies that are always looking for more cash
Well,
flow.
So yeah, so that it's been definitely been the way the businesses and the companies have gone up here. Yeah, I mean the problem is, again, it comes down to, I mean, we're not going to give something away for 18-year reserve life, proven reserve life for 2 or 3 times cash flow, right?
Yeah,
Like
yeah, right. Yeah,
unless it's just one hell of a company and one hell of a management team that I haven't met yet.
yeah, yeah. Well, and then you could take their shares too. There's a way to do that too.
Yes, but again, then you're, then I have to look every shareholder in the eye and say, hey, I believe in these guys, fully and wholeheartedly, that they're going to work as hard to return to shareholders that we get up every day and do. And
Yeah. And with bigger companies, sometimes assets of this size don't get the attention they deserve. That's for sure.
yeah, I think, it depends. I mean, the likely scenario would be, a company like Hemisphere at let's say 3,000 to 4,000 barrels a day. We get into in 2023. There's a handful or a number of companies that are 15, 20, 25, 40,000 barrels a day. Like, that's still it's a meaningful acquisition for them, meaningful free cash flow for them, no debt for them, no wellbore liabilities. I mean, it's a rounding error when it comes to it. I mean, we've set ourselves up to be a great target if the market really gets to that state. If not, if we're going to continue, like, let's say the world doesn't change, we continue to trade at 3 times. Well, you know what? We'll dividend out that extra return to so that people get the value of
let me ask you this: do you see the Canadian people? Are they watching what's going on in Europe?
Oh yeah,
with this catastrophe of an energy plan that is failing.
Yes, but they're well aware of it.
And it's not just a Russian invasion of Ukraine. They were in big trouble anyway, huge trouble anyway.
What they're missing, though, Dan, is that we're not that far away from energy crisis here in Canada. We are not well connected through our own country for energy security, for affordability, reliability. That's the part that the majority of our population doesn't understand. They think this is just a European problem.
Yeah. I hope the people in Eastern Canada realize that the U.S. exports gas and stuff to Eastern. You don't have pipelines going from Calgary all the way across to Quebec.
Very few. You're right. Like, most of so in Eastern Canada, most of the natural gas would come out of the Marcellus, and then for oil, a lot of it gets tankered up the St. Lawrence from Saudis, from Nigeria, from
Well, the talk, the rumor is now that the Biden administration is looking at everything. So they're talking about banning exports of refined products.
I've heard.
I tell you, that would be a disaster for the Western Hemisphere.
Yes.
The Western Hemisphere, including Eastern Canada, depends heavily on refined products coming from the United States.
Yep.
And I mean, think of the Caribbean countries. There are no Caribbean countries that, they get all of their refined products from us. So if you banned it, you've destroyed the economy of half of the Western Hemisphere. It'd just be a disaster. But they've done some really stupid stuff. So who knows? Anyway.
I mean, no one asked me what keeps me up at night, but it's probably, it's less reservoir and less price of oil. It's more government intervention that keeps me up at night.
Yeah, that's always something to worry about. But I think the last question we heard Ed asked, have you seen oil production rates increase since the Polymer injection? I think we covered that. And the answer would be yes at the G pool, and it's just too early at the F pool. but 6 months to 9 months from now will be. I'll just remind everybody that Don is coming to Houston to host lunch for us on November the 28th. You can register for that event on our website. Our next webinar will be a week from tomorrow. Let's see, a week from tomorrow. Surge Energy is hosting. This will be the first time we've taken a look at Surge. And I know, Don, you like Surge, don't you?
Oh yeah, I'm a shareholder. Yeah.
Okay.
Yeah, no, it's a great company.
Well, be on the call because they got a very similar situation. They're generating a lot of cash flow at these prices. So it's one definitely to take a look at. Hey, thanks for doing this again, buddy. And we'll see you in November. I'm looking forward to hearing your well results on these next 4 wells that are going to be completed.
Yeah, well, thanks again for having me, Dan, and for everybody tuning in, and yeah, feel free. I mean, if you didn't ask a question or something comes up before I come down there, just send me an email, give me a phone call. Happy to chat anytime.
Okay, thanks a lot.